Okay, so what I'm going to do now is just what we would do in class. I'm going to go back to the worksheet. So I am in 4E. I'm going to skip number 1. I think we all did that one in class. I'm going to go on to number 2, which many of us, we might have done this one already, but it's a good one to review, and it's a good one to review for the test, for sure. If you need a copy of the 4E worksheet or this table here that I'm using and I handed out in class, make sure you send me an email. I can get you all that. I might just send you everything anyways, just so we're all on the same page. All of the classes now are done with 4A, 4B, 4C, and 4D. 4E is the last section before the test. So let's go through number 2. I know there's like a weird shadow here. We're trying to figure out the lighting situation, but I'll write it and then I'll try to stand out of the way. And again, if you have questions, please just tell me kind of what section you have a question on and what number, if it's on a worksheet or on one of these videos, and that would be great. Let me just check something real quick. Just making sure we're going. Okay, so this is 4E and it's number 2. Marie earned wages of $88,750, okay, plus she received $4,900 in interest from a savings account. Then she contributed $6,200 to a tax-deferred retirement plan, okay? She was also entitled to a personal exemption of $4,050, and she had deductions totaling $9,050. It's all right here in number 2. Find her gross income, adjusted gross income, and taxable income. So again, we're going back to this flow chart here where you start at the top, go down, go back up, go down, same thing all the way through. So for gross income, the first one, gross income, remember, is just any money she has coming in. Income, money coming in. So what did she make? Well, she made $88,750 plus she received $4,900 in interest. So when we add those together, this will give us Marie's gross income, which is what? Oh, I need a calculator for this. Oh, I have it written down. Look at me. $93,650. Okay, that is her gross income. So that's the first part of the question. Then they want to know, okay, what's her adjusted gross income? Well, if we go back to the flow chart here, we take her gross income and we subtract any adjustments to income. So remember, an adjustment is maybe she contributed money to a tax-deferred retirement plan, maybe she put money into her kids' college fund, something like that, tax-deferred. You're kind of moving money around. An adjustment is not, it's not either an exemption or a deduction. Those will come later. So remember, an adjustment is, in Marie's case, she contributed $6,200 to her tax-deferred retirement plan. So that is her only adjustment. So now we subtract those and we get $87,450. This is her AGI, her adjusted gross income. Okay? I encourage you, even though you can kind of watch me on here, I really do encourage you to write this down, label it, because it's just one more way to help your brain kind of process this information. Learning about this a lot right now in my classes I'm taking for my master's. It's super interesting. Your brain processes information in so many different ways, and the more ways you can kind of pour that information in, the better. So I encourage you to kind of go through it, write it all down, make sure you really understand it. Don't just kind of watch the videos and skip through and listen to me, blah, blah, blah. Okay, so that's her adjusted gross income. I'm just going to rewrite it. I'm on a really small whiteboard. I miss my big giant whiteboard. I'm just going to write it over here. Remember, this is her adjusted gross income. Then we're back to our flow chart here. We have our adjusted gross income. We go back up. Then we subtract any deductions or exemptions. So Marie, of course, has, for deductions, she has $9,050. So we'll subtract $9,050. And she also has, I missed it, the personal exemption of $4,050. So we're going to take that, subtract, and subtract again, and that gets us to, I already did the math out, but again, I encourage you to do it on your calculator too. $74,350. That is her taxable. I know, sorry about the weird shadow. We'll figure this out. I forgot to see. Taxable income. And that's it for number 2. I want to say any questions, but you can't really ask me questions. So obviously it's a video, so you can now pause that. So I'm going to go on to the next one. We'll do number 3 next. Again, I skipped number 1. I think we all did it in class anyways. Number 1 and number 2 are very similar. Let's do number 3. Let's talk about number 3. It says your deductible expenditures are $3,700 for contributions to charity and $7,060 for state income taxes. Okay, that's money you spent that you are allowed to deduct from your taxes. Your filing status entitles you to a standard deduction of $6,350. So they want to know, should you itemize your deductions or should you take the standard deduction? Remember, we want to take away the greatest amount of money possible because that's money that we don't have to pay taxes on. So we can either say, okay, well, I donated $3,700 to charity. I also donated, where is it? $760 to charity. So if I add these together, I will get $4,460. So if I itemize my deductions, I'll get to deduct this amount of money. However, oh, I already wrecked it. However, if I take the standard deduction, they said it's what? $6,350. So when you're choosing, you can either choose to itemize or you can choose to take the standard deduction. You only get to pick one. For most people, I don't know what most is, but I would say the majority of people, greater than 50% of people, this is what they'll choose. You'll choose the standard deduction. Some people will itemize. It depends on if you own a home or something like that. I think I told some of you in class, this was the first year I actually had to itemize my deductions because I got some, again, not a tax expert, not an accountant, but something I itemized for paying my mortgage interest or something like that. But anyways, you choose which one is the bigger number because that's the one I want to pick. I want to pick the bigger number because that is what I do not have to pay taxes on. So you don't want to pay taxes on the bigger number. So number 3, you would choose to take the standard deduction. All right, you can pause the video if you have any questions. If you have any, again, I would say you can post them on YouTube. I'm going to try to check it. It's just something I have to get used to again. But I would just email me or text me, whatever you're comfortable with. All right. I'm going to skip number 4. I am going to go on to number 5. Number 4 is kind of similar to number 2 and number 3, like combined. So that's why I'm going to skip it. But again, if you have questions, let me know and I can always kind of come back in and add these. So I'm going to go on to number 5. I'm going to do number 5 for A, Sarah, and Marco. So it says use the marginal tax rates. That's right here. And again, I'm using this sheet. It's from 2017. Of course, they're different now. I think we've talked about that in class before, actually. Now we're talking about tax year 2019. Some of the numbers are very, very different because tax laws have changed. But let's talk about this one for Sarah and Marco. Let me just check on my video, make sure we're still going strong. Yeah. All right. So Sarah and Marco are married filing jointly. So if you're looking at your chart, that's this column, married filing jointly. That's what we're going to consider. And they have a taxable income of $87,500. I'm going to write that down. $87,500. Okay. So they want us to use those tax rates to compute the tax owed in each scenario below. So this is how much they make. I think I showed some of you guys. I'm going to make this almost look like a bar graph. I need some more colors. We'll have $0 at the bottom, and we'll have 87,000, right? Yeah, $500 at the top. Now, if you look at these tax rates, remember for married filing jointly, here are the tax rates. So it means up to $18,650 will be taxed at 10%. So I'm going to call this $18,650. So this amount of money here will be taxed at 10%. Can you guys see that okay? I'm going to check the video. Oh yeah, it doesn't look too bad, right? Hopefully it doesn't look too bad. Okay. So that first chunk of money is taxed at 10%. So I guess I'll do my math over here. So $18,650 at 10% or 0.10, right? It's a decimal. I need like 6 more boards. Gives me 1,865. I just moved the decimal over. Okay, so that's how much they pay in taxes on this first amount of money. I'm gonna do a different color now. I got this whiteboard the other day and it was like, I was nerding out. I was very excited. So the next chunk of money from $18,650 all the way up to $75,900, we'll say that's like right here. We'll call that $75,900. This amount of money in here will be taxed at 15%. Okay, so I need to figure out, well, how much is this chunk of money? It's not $75,900, but it's the difference between this and this. Difference, right, means subtraction. So I'm going to say 75,900 minus the 18,650, which gives me, you guys can probably do it faster on your calculator, 57,250 gives me 57,250, and that's taxed at 15%. I'm going to go back to black just because I think it's easier to read, but let me check on the video again. Yeah, it's okay. So the taxes on this green chunk of money come out to, hopefully you guys got $8,587.50. So far I'm paying this in taxes plus this in taxes, and we're going to need to calculate more for this last section here. So now to figure out what this is, I'm going to take this minus this, and it's going to be taxed at what rate? If you go back to your tax rate chart, we're saying, okay, well, up to $153,100, but of course they didn't make that. They only made $87,500. So the difference between these two, $87,500 minus $75,900 equals $11,600. $11,600. And what rate is this again? What tax rate? Let's go over. That's 25%. So this little chunk here is at 25%. So I'm going to multiply this times 0.25. Sorry about the shadow. And I'm going to get $2,900. $2,900. Okay, so I need to pay the government this for this amount of money, this for this green chunk of money, and this for this last black chunk of money. So I need to add this, this, and this all together to come up with what we call our total tax bill. How much money do you actually owe the US government? And if you add this plus this together, you should get, I'll write it down here. I think you can see that. I got $13,352.50. It's my grand total. That's a 5. $13,352.50. And you say, well, that's a lot of money, right? Might be a lot of money, but what's been happening all year? Right, you've been getting money taken out of your, or Sarah and Marco hopefully have been getting money taken out of their paycheck all year, right? You get paid a certain amount, but then you have things taken out. Income taxes, Medicare, Social Security, all those things get taken out little by little all year, because at the end of the year, you probably don't want to write a check for $13,000 to the US government. Some people do. We've talked about this, one of the classes and I talked about this, I think, a lot. Some people like to get a refund, right? Getting a tax refund is nice. I got one coming soon. But other people actually like to owe the US government money. And why is that? Well, because if the government owes you, say, a nice $3,000, you do your taxes, you file, and it says, okay, the federal government owes you $3,000. Well, what have they actually been doing with that money all year? They've been borrowing that from you interest-free. They're taking a loan from you all year long. They'll give it back to you eventually, but interest-free. In kind of, not retrospect, but the opposite way, you can kind of do the same thing. You just have to make sure you're able to pay it back at the end of the year. You can borrow a couple thousand from the government all year. I think there's a limit to where they'll start to charge you fees, and then just pay it back at the end of the year and be like, oh, I was just off a little bit. But it's just something to think about. People that really like to do investments and stuff, consider that, but a lot of people just like to get a nice tax refund. So that was 5A, 5B, and C are very similar. I'm going to erase this one now. Again, if you have any questions, just let me know. This whiteboard is just hanging on. I was at Staples the other day and everyone was buying office chairs. Thought that was funny because obviously so many people now are working from home or doing school from home or whatever. It amused me. Let's talk about number 6. I don't need to necessarily write it on the board, but let's talk about number 6. Vanessa is in the 35% tax bracket, and she claims the standard deduction. How much will her tax bill be reduced if she qualifies for a $1,500 tax credit? So remember, a tax bill is that final amount you owe the US government. If your tax bill is negative, well, then that means they owe you money. In that last example, Sarah and Marco owed over $13,000, okay? Vanessa, in this case, gets a tax credit. So a tax credit comes directly off your tax bill. A tax credit comes directly off your tax bill. So if you owe the US government $13,000, like Sarah and Marco or whatever it was, if you have a tax credit for $1,500, say, you subtract $1,500 from that, and your tax bill will instead be $11,500. Okay, so it comes directly off. It's basically just money you get directly back. There's no factoring in tax rates or anything like that, which is nice. And tax credit comes directly off your tax bill. Let's talk about number 7. It's kind of different. Sebastian, I'm going to erase this and read through it. Sebastian is in the 28% tax bracket, and he itemizes his deductions. How much will his tax bill be reduced if he makes a $1,000 contribution to charity? So if his highest tax bracket is 28%, it means he's itemizing his deductions. Well, that's what it said in the problem. That's not what it means. But since he's itemizing his deductions, it means he can not pay taxes on this $1,000. So instead of getting taxed at 28% on this, he does not have to pay that amount of money in taxes. So to figure out how much his tax bill changes, we just take this and we multiply it by 28% or 0.28. And we say, okay, he does not have to pay the US government $280 since he would have gotten taxed on this, but it's tax deductible. All right, what else we got here? I'm going to pause there because this video is getting long. I'll make we only have a couple more, but I'll make a 4E like part 2 just because this video is getting long. Okay, thanks.